doing a reverse mortgage to actually buy a home. That's what we're going to talk about here today. Michael writes in, actually, where's Michael from? He asks, hold on just a second, from Michigan. He says, Michael says, Josh, first of all, thank you for all the fine videos you've posted. I'm near retirement and have learned so much from your videos. In an effort to pay it forward a little, I thought you might want to cover home equities or home equity conversion mortgages for purchase. I did not know this product even existed, but would love to hear your view on this. And he gives us a Forbes article that our man Wade Pfau talks about. So let's go into this. Wade just written this. I'd written just how do I close that guy? There we go. Right. Close it. All right. Wade had just written this for Forbes, dated, saw the date, April 10th, so just the other day. Sorry about my formal attire. It's a Saturday. Doing some yard work, doing videos, going to go for a jog. It's pretty high class here at the Heritage Wealth Planning YouTube channel. All right, so if my man Wade writes it, I want to learn about it. Home equity for purchase program. So thanks, Michael, for your thought on this. I hadn't seen this article. I'm looking forward to reading it, as a matter of fact. And my man Sergio, I forgot his last name. I want to say Santana, but he writes a lot on the comments on the YouTube channel about home equity conversion mortgages, otherwise known as reverse mortgages. So Sergio, if you're out there and you want to chime in, love to hear you for sure. Anyway, home equity conversion mortgage, reverse mortgage for purchase began in 2009 as a way to use reverse mortgage to purchase a new home. The government saw enough people using a costlier and more complicated two-step process, obtaining a traditional mortgage to purchase the home and then using a reverse mortgage to pay off the first one, that is sought to simplify the process and cost. The government. The HECM for Purchase program allows fewer distribution needs from the investment portfolio because a greater portion of the home's cost can be financed by the reverse mortgage, which does not require payments until the loan balance becomes due. And again, we got Wade's book. Let me find it here again. Book, Reverse Mortgages. How to use reverse mortgages to secure your retirement. I'm telling you, I've marked this sucker up a lot, as you can. Look at that, just all over the place. It's a great book. I don't know, $18.99 or something like that on Amazon. Just absolutely, you should get it. And if you get through my link, I get paid, man. Get paid 4% commission. Let's see. The home equity, the reverse mortgage program can be used to either downsize or upsize a retirement home. For those downsizing, the reverse mortgage could free up more assets from the sale of the previous home to be used for other purposes. For those upsizing with the financial resources to manage this sustainably and responsibility, the reverse mortgage could allow for a more expensive home, especially considering the possibility that obtaining a traditional mortgage might become increasingly difficult after retirement. See, I think that gets overlooked a lot. You're not getting a mortgage if you have no income in order to support the mortgage. I just cannot. I'm just telling you, I used to work in banking. I know how these things work. They call them the 4 C's: credit, collateral. I can't remember the other ones. Credit, collateral, cash flow, and something else. 4 or 5 C's to determine credit quality and worthiness in order for them to secure financing to you. And if you have no income other than Social Security, it's not happening. Should the borrower live in the home long enough, the loan balance may grow to exceed the value of the home, setting its non-recourse aspect into motion. Again, non-recourse means you'll never owe more than what the home is worth. Not you, not your heirs. It will never be worth. You'll never have a debt more than what the home could sell in terms of that's called non-recourse. If the home is worth $500,000 and you owe $600,000, that $100,000 is wiped off the mat. That's part of the 3% I think is the closing costs up front that you're paying into the federal government, the FHA insurance. You're paying, I think it's 3%. Don't quote me. Go to Wade's website, which is retirementresearch.com or retirementresearcher.com. But that's why they can offer non-recourse loan, because you're paying a significant mortgage fee on the insurance fee on the front end. In this situation, one could interpret the reverse mortgage program as a way to provide housing services as long as the borrower remains eligible for a total cost equal to the portion of the home value and upfront costs not covered by the reverse mortgage. Should the borrower leave the home while the loan balance is still less than the home value, the home can be sold and with any remaining equity still available to the borrower. In terms of the coordinating the use of debt for housing, not having to make the monthly mortgage payment reduces the household's fixed costs and provides a potential relief of any need to spend down investment assets. I mean, I 100% agree. And don't forget, the money that you're using, it comes if you use it. Well, I guess in this case it won't matter, but it's tax free. It's tax free. The reverse mortgage for purchase option can be analyzed relative to paying outright for the home with other assets. All right, so give us a study on this. Okay, let's keep going now. Okay, here we go. A case study on the reverse mortgage for purchase program. Consider a 65-year-old couple retirement with $1.4 million in tax-deferred retirement plan and a desire to purchase a new home costing $300,000. The couple considers whether to pay fully for the home with a portfolio distributions, whether to take out a traditional mortgage on the home, or whether to fund a portion of the home's costs with a reverse mortgage. Again, it's important to note that the traditional mortgage option may not always be available. Could not agree more. Because look, I'm telling you, I've had many a client get declined a mortgage, even though they have 1.4 million in assets, because it's in retirement assets. The bank can't use that as a collateral, and they can't attach themselves to that retirement asset. It's literally free from creditors. That's one of the benefits of the IRA, is it's free from creditors. But that also means the bank has no collateral if you don't cash flow. Paying cash for the home requires a $300,000 distribution and plus an additional distribution of $100,000 to cover the taxes on the portfolio at a 25% marginal tax rate. I 100% agree. 100% agree. And this is why I talk about long-term care all the time. People say, well, it's going to cost me $80,000 a year on long-term care, whatever. When you factor in taxes, it's going to cost $100,000 a year because you're pulling it from your IRA. You're pulling $80,000 from your IRA. You're going to have to pay 20%, 25% tax on the $80,000. So it costs you $100,000 to finance $80,000 of long-term care. From the traditional mortgage, the couple considers a 15-year with a 3.5% fixed rate and a 20% down payment. This requires $60,000 upfront plus $20,000 more to cover the taxes and mortgage payments of $20,838 a year. For the reverse mortgage, the current 10-year swap rate is 2.25%, and the lender's margin is 2.25% as well. At age 65, this supports a principal limit factor of 45.9%. Full retail upfront costs include $5,000 for the origination fee. That's the mortgage premium right there. $6,000 for the mortgage insurance premium, and $2,500 for other closing costs, for a total closing cost of $13,500. The reverse mortgage covers $137,000, while the investment portfolio covers the other $132,000. It is actually 2% of the house amount is a mortgage. The insurance, the mortgage insurance is 2%, not of the loan amount, of the actual house appraised amount. Let's see. While the investment portfolio covers the other $162,000 and $13,500 for the upfront cost, plus another $58,000 to cover the taxes on the distributions. All right. So Exhibit 1, does he give us in a chart? Yeah, here we go. Sweet. All right. I like the charts. Use a reverse mortgage to cover as much as the home is allowed and pay cash for the remainder. There is no additional line of credit available with the strategy. 2, use a reverse mortgage to cover as much as the home is allowed and pay cash for the remainder. But subsequently, for years when markets provided positive returns, make voluntary repayment equal to the traditional mortgage amount, but skip these payments after down years. Use a built-up line of credit to cover the retirement spending goal if the investment portfolio depletes. Number 3, open a 3.5% 15-year fixed-rate conventional mortgage with 20% down. Open the reverse mortgage only as a last resort if the investment portfolio declines. Number 4, pay cash for the home. Open the reverse mortgage only as a last resort if the investment portfolio depletes. Number 5, open a 3.5% fixed rate 15-year mortgage with a 20% down. Open a reverse mortgage line of credit for later use once the 15-year mortgage has been fully repaid. Okay, open a reverse mortgage line of credit for use. Okay, I got you. And then pay cash and immediately open a line of credit on the home to use it for retirement spending if and when the portfolio depletes. Okay. Exhibit 1.1 provides the results in terms of the ongoing probability of success and meeting the spending goal throughout retirement. The strategy supporting the highest success rate is number 2, using the home equity conversion mortgage for purchase and making voluntary repayments on the loan. So let's take a look what it was. You're going to use the home equity, the reverse mortgage to cover as much of the home as allowed and pay cash for the remainder. But then in years when the markets are up, make voluntarily repayment schedule to the traditional mortgage payment and skip those payments after the market's down. So the market goes up, you take your gains and pay down your mortgage. I like that. Then what happens is when the markets are down, you're not taking your money out of the line of credit, so you can use that for other things. I like that a lot. Strategy 5. Let's just take a look here. So we got. I wonder if I can make this bigger. Really let me big it. But anyway, so we got all right. So here's the best strategies. Probability of success. Number 1 and 2, it looks like use the full reverse mortgage for purchase with voluntary repayments, and then this one right here, which is blue, which is this guy here. This guy right here, number 4, obtain a 15-year mortgage, then open a line of credit right away. All right, the home equity line of credit, a reverse mortgage line of credit, and then number 2 is the dark line, which is this guy. What is that? Let's use it. Okay, with voluntary repayments. That's number 1. Number 2. Okay, these I got you. So this is number 1 and number 2. So use a 15-year mortgage and immediately open a reverse mortgage for the line of credit. And then number 1, the best one was use the home equity, the reverse mortgage, and pay it back once the markets are up. Number 2 I guess you should say number 3 was using the whole home equity conversion mortgage for purchase and not paying it back. That gives you the third best scenario. The least scenario is pay cash for home and use the reverse mortgage as a last resort. Let me just go back to this right here. Pay cash. Let's see. Open it right here. No, wasn't it right here? Open a 3.5% fixed rate 15-year conventional mortgage and open a reverse mortgage for later use once the 15-year mortgage has been fully paid. All right. No, pay cash for let's see what he says here. Strategy 5 has similar outcomes. Okay, strategy 5, open a 15-year conventional mortgage and open a home equity reverse mortgage line of credit for later use once the mortgage has been fully repaid to live off. Okay. As a legacy of value assets, the outcome are very similar to those we discussed before, so I do not include exhibits to describe them. At the median, the reverse mortgage for purchase with voluntary repayments is able to support the highest legacy values, but the other strategies are close behind. At the 10th percentile, poor investment returns outcomes are almost indistinguishable. At the 90th percentile, excellent investment returns, strategies that keep as much as possible in the investment portfolio, such as the home reverse mortgage for purchase or the 15-year mortgage, support substantially higher legacy outcomes, which inherently makes sense. I mean, so what's happened here is they're saying, look, if the markets do great, you're not going to want to tap into your portfolio. That's all there is to it. If the markets do poorly, at the end of the day, the markets do poorly, the reverse mortgage still plays a role because you don't have to tap into your portfolio when the markets are doing badly, because your home equity conversion mortgage is taking the income stream that you need from your portfolio off. The stress of the portfolio when the portfolio is going down is being replaced by your reverse mortgage, which inherently makes sense. That's what you want. So the market's going up. You want to let the markets continue to work as glory with the beauty of compounding interest without having to tap into it. The markets are going down. You don't want to take in a portfolio, take distributions, because you don't want to sell on a declining asset base. And again, another reason why the line of credit, the reverse mortgage line of credit works. So pretty good article. I'm a fan. I mean, there's no other way around that. I've said this a million times a Sunday. I get the issue. I guess I don't let comments in here. The truth about index annuities and market risk. I have to look at that. Pretty good article. But yeah, you can use the home equity conversion mortgage to buy a home. You absolutely can. I'm a fan of doing it. That's what I plan on doing. It doesn't mean you should, but that's one of my thoughts. Absolutely. All right. Hope you like this. Thanks for the email, Mark. We'll see you.